have, depending on your interpretation, are performing a noble act of wealth redistribution, or if you're part of the salons of Wall Street, and all of this, by the way, harkens back to one of the great video efforts of all time. And of course, I'm talking about that seminal 1980s undertaking where we explored class warfare and the philosophical question, is someone a product of their birth or their education? And of course, I'm talking about the great movie Dan Aykroyd, Changing Places with Eddie Murphy. A lot of changing places going on right now. But, you know, over the years, I have been blessed to have our guest on as, well, he's certainly qualifies as a repeat offender on the Coalition Talk Radio. I don't see him often enough, but I consider him a great friend. He is a remarkably astute, if you will, well, let's just put it this way. The markets, with the capital T and the capital M, are not in his blood. They are in his DNA, his RNA, whatever the folks are calling it these days. But ultimately, this gentleman is a product of the free market and the markets themselves. In 1973, if I get that right, he made his entree into, if you will, the Chicago Board of Options Exchange. And as a result, has had a lifetime well lived, being on literally every side of the equation. We certainly could use him in Rhode Island today based on the performance of today's leaders. He is, of course, Michael G. Riley. He is a co-founder of Coastal Management Group, LLC. He's a UConn grad, but he's done graduate work at Boston University and Stanford. It is my privilege to reintroduce on our new version of the Coalition Radio, Coalition Radio 3.0, someone who again, a great friend and a market pioneer, Mike Riley. Mike, welcome back to the Golden Microphone.
Hi, Pat. Long time no talk. I got a question for you. I can hear you now on my system. Can you hear me without?
Yep.
What if I take my phone away from my head? Can you hear me now?
Can we? Yeah, you're good, actually. Let's try that for a second here.
Yeah, somehow your volume just kicked in.
Excellent. Listen, well, I'm going to be really blunt. There's two folks here in the secret location high above the hills of Providence. One of them is an adult, and I happen to be on the microphone. So thanks, as always, to super producer Mickey, because I used to consider myself technically well-versed. Fortunately, she has held our hand this evening in order that we can shake hands digitally. So we're all good, buddy. Let her rip. What the hell is going on?
What's going on, well, to me, just a larger perspective, what's happening right now, and realize that I've been 1973 until now, I've been through every single market, every minute of nearly every day since 1973.
And so let's reflect on that a little bit. It would be because it's important to set the stage here, because even more so than the last time we talked a year or so ago, the market is, what is it, Bruce Springsteen song, 200 and something channels and there's nothing on. You and I were chatting this morning, and we were talking about how you'd have breezy analysis that the market's disturbed. It has indigestion today, where it's refining its viewpoint. The level of absolute nonsense out there is astonishing at a time where, in the middle of a pandemic, more is riding on market performance, whether it be the Rhode Island's crippled pension systems or just the individual's 401k. So feel free. Let's go back in time and for folks who haven't heard you before, let's reestablish your bona fides and give folks a flavor for what you've been through over literally a lifetime of marketplace warfare.
So I was born on the trading floors, as opposed to what we used to call it down on Wall Street, upstairs. And so the firms like Goldman Sachs or Salomon Brothers back then, which you don't even hear about anymore, they were upstairs in buildings with trading desks on a floor and a skyscraper. The real trading floors were the New York Stock Exchange and the American Stock Exchange and the Chicago Board Options Exchange. And those were physically on trading floors with all kinds of people making trades by paper. And it was quite the scene. And we used to have a lot of interesting things happen on the trading floors. But the major events that I'm kind of referring to, like I was there and actively executing orders in the Hunt silver crisis of 1981. So that would be step one. Step two would be 1983. And this is a lesson for everybody today, I think. There was a huge speculation going on in computer stocks. Well, we already had personal computers, and everyone decided that personal computers were going to be the future. And this didn't take a lot more than what people today are using for their analysis of what stocks to buy because there's a short squeeze. Everyone knew there were personal computers, and that was the future, and nobody had any insight beyond that. And so there were very few companies that you could trade the stocks on that were actually involved in it. They were Atari, Commodore, Coleco, Tandy. So all of these names that people were buying like crazy because they knew computers were going to be the thing, they were all gone 4 years later. So just because you have a 4-year outlook on an industry doesn't mean you're buying the right stock. Wow. So that was lesson number one. So 1987 was obviously a crisis. And in 1987, I turned to my partner on that Tuesday morning, not the Monday morning of the crash down 22%, but I turned to my partner on the Tuesday morning when everything went silent and nothing could open on any stock exchange because they didn't have buyers and sellers. And it was eerie. The exchange was silent. And I turned to him and I said, well, it was nice working with you. We didn't speak another word for 2 hours. And then all of a sudden, somebody, quote unquote, probably the Fed, came in and started executing trades to get the markets open. And the markets did open. They had a very rocky day. But most of the firms like me, and this is actually a concern right now, but most of the firms like us were using our capital to make markets when everybody was on one side of the market. They were all sellers. And the function of a market maker and specialist, which I was to be the other side. But we didn't have any more capital. And so the exchanges wouldn't let us stand there and buy when we didn't have any capital because they knew they'd have to bail us out. So it was a very tenuous situation. And somehow we got through it, and I was there for that. So I think that was pretty bad. 1990, the Kuwait, the invasion of Kuwait was a big deal, and a lot of people lost a lot of money in that period, but not as big a deal as going forward 1998, the Thai baht crisis and long-term capital. If any of you remember long-term capital.
Yes.
Right. A bunch of geniuses got together, and I knew a couple of these guys, and they were supposed to be the smartest people on Wall Street, not unlike all the people that you saw today if you're watching CNBC, the equivalent of Chamath Palihapitiya or whatever the hell his name is. And they were supposed to know literally everything. And they created, a hedge fund type book, which they were long and short, various correlated items in their mind. And suddenly the Russian ruble collapsed and the Thai baht collapsed. And that blew up all their models. And there they were with an entire portfolio of things that was now suddenly illiquid. And they had borrowings out with all the major firms on Wall Street. Goldman Sachs, JP Morgan, all of them. And they had to have a meeting amongst those firms to bail out long-term capital just to keep the markets open, which they did. Can you still hear me?
Absolutely. You're perfect.
So going forward, I was the specialist in Dell Computers, Yahoo, Cisco, Amazon, in the dot-com bubble. I was responsible for trading, being the other side of all the option trading in the biggest speculation up to that moment in time in history. Up close and personal. Same issue. Orders come in, They overwhelm the marketplace. I have to put on extraordinary risk just to make the markets. And our lenders are asking me, what are you going to do if Yahoo goes from 500 to 300 today or whatever? Mm-hmm. And of course, we didn't have any good answers for that. Of course not. And so I was there for that. And that was, up until now, the biggest, craziest market I've ever been in by a long shot. This market now, today, is 10 times more speculative than the dot-com era.
If you could reflect, if you will, reflect on some of the individual components here, market makers, where are the, kind of the different roles. Let's as we play this sort of Game of Thrones, you've got the market makers, you've got the hedge funds, you've got old Wall Street trading firms, the Fidelities, it's interesting, we're referring to Fidelities and E-Trade as the old ones now. And then of course you've got Robinhood and, these newer day trading style, or these quote unquote democratically, not the political, but the democratically open markets. Everybody can participate if they've got $50 kind of market. What role do each one of these play?
So it's all pretty much a complicated structure, although today is less complicated than it was back then because there were many more attempted entrants. There were the discount brokers, Scott Trade, and so on and so forth way back then. And the first evidence that I saw of things like we're seeing today, which is a Robinhood type activity or Ameritrade type activity or Schwab, where cheap execution is promised and quick return of execution, so the customers knew where they stood and what price they bought it at or sold it at. That's all occurring much faster now, but it occurred back then in the Scott Trade and same firms, by the way. Charles Schwab was in back then in the dot-com bubble, and they're in the middle of this one too. But back then, the median for communicating buy and sell opinions were beepers. I don't know if you remember the beepers that people
yeah.
Mm-hmm. wear on. Yeah, they would. So somebody would recommend something, and then somebody standing in my crowd who represented a brokerage firm like Charles Schwab, I was the specialist. I was the person responsible for making a two-sided market. He was a broker representative, public broker, or we called him $2 broker on the trading floor. And he was responsible for reflecting his customers' desires and orders. He would get beeped on something, and he would realize that he had to call his booth and get a series of orders for whatever option that was. In my case, it was mostly Yahoo that we were trading. So he was not a market maker. Next to him are crowds of guys that are similar to me who have less or no obligation to put up their capital and make markets, but they're allowed to participate. So to me, as specialists, as long as they're making both sides of the market, a bid and an offer, they could participate on trades if they traded on the bid or the offer. However, anyone was allowed to execute in the middle. If the market maker wanted to sell it cheaper than I did, he would just go sold, and he would sell it, and so he would interact with the public. So that's the mechanics of that. Now, what's happening today is Citadel, and this is all, by the way, I think this is ironic. Arthur Levitt was the chairman of the American Stock Exchange before he became the SEC chairman. And Arthur Levitt had this notion that he was the little guy's savior. And without going into my dislikes of Arthur Levitt, he kind of painted a picture like he was the public's hero. And he is the one that is responsible for payment for order flow today, a term that I think maybe you've heard. Mm-hmm. Well, the way orders are executed today through Robinhood is Citadel, which is a very large hedge fund, pays to be the other side of every single trade that Robinhood does. They pay them for all the orders. And then Robinhood turns around and says, oh, we're not going to charge you anything to the customer. This guarantees the customer is never getting a best price. They're never executing in the middle. They're executing on the bid or the offer, and they're executing through the computer, and they're executing automatically without exposing to any other market makers that may be interested in trading with them. They've already made an agreement with Citadel that, you pay me X for each order, and I get to buy and sell everything that you send me.
If you could expound on that a little bit, because that's a critical point. I think folks like myself, if they haven't met you personally and had these kind of conversations, they don't realize that, because you buy a stock for X, that doesn't mean you necessarily got the best price. And the offset, if you will, between fees people might pay for transactions or financial management and what they're paying for the actual stock. There's no such thing as a free lunch, right, Mike? So how do these folks make their money?
So Citadel makes the money because they believe that all that order flow is dumb. And they want that order flow. They want to be the other side. And so Citadel pays, in this case, Robinhood, for each order that they send them. And they prefix what that amount is, and the customer doesn't see a commission. There is no commission as far as the customer is concerned. So the only way he's going to do better than the bid or offer is if somebody improves his price. Citadel has no incentive to improve the price, none at all, and is likely electronically, automatically executing, interacting with the customer. And many of these options trade on more than one exchange. So if Citadel happens to have a presence on the CBOE as opposed to the New York Stock Exchange, American Stock Exchange, or Pacific Coast Stock Exchange, it's delivered to wherever Citadel is, and it's not exposed to the other trading floors.
Right. So, and ultimately, that lack of exposure is costing the investor money, correct?
Yes, and there are more subtleties that go on. If Citadel, for example, is the center of order flow, is where the orders are coming in, and they see about, 80 different orders coming in a 10-second period, they're only required to what's the name of that? Robinhood. They've only made an agreement with Robinhood to execute a certain amount of contracts on the bid or the offer when the order reaches them. So when they're actually executing the order and matching it in their system, they are also moving the market, even though they know there's 7 orders in front of me to buy. So in an example, just give a simple example. 10 orders come in over a period of time. They've guaranteed that up to 50 contracts to Robinhood at a price, but those 10 orders total up to 500 contracts. They're all 50 lots. The first order in gets executed at the price. Those next orders get executed at some other price and are not exposed to any other market makers.
Wow. From your perspective, you've seen these different waves, these market disruptions in the sense of trading partners, and you've seen, for example, Fidelity move from being really an exchange traded fund house, if you will, a mutual fund house, to now being an active trader, to now not charging for fees. You've seen the E-Trades of the world pop up as pure startups, and now they're almost considered an establishment house. The methodology by which these newer disruptors deliver, what's your thoughts on the impact of that and the services they provide versus, a quote-unquote conventional brokerage house would provide?
So I think by and large, discount brokers these days with the tools that they have are very good for the customer. I clear through Interactive Brokers. One of the things I got mad at today was when I when I saw the people yelling at Interactive Brokers, which I've had to yell at in the past as well. But I'm a hedge fund, and I clear through Interactive Brokers, and all these people were on the Twitter complaining that Interactive Brokers wouldn't let them execute what they wanted to execute in certain names, GameStop being the most notable. I wasn't allowed to either, and I'm a hedge fund. So it wasn't just one-sided by Interactive Brokers. Interactive Brokers was legitimately concerned, and this is a major point, was legitimately concerned that there are firms in the industry right now, in the stock market and in the option industry, that aren't well capitalized enough if their customers lose money. So for example, let's say tomorrow GameStop opened at 0, down. I just saw it trading right now. It's trading, it's up 100 and something overnight. It's trading at 330. For all you GameStop fans, way to go. I'm not happy because I'm short it, but you know, all is fair in love and more. So what could happen is a Lehman Brothers type scenario. Lehman Brothers, if you remember, wasn't going broke because of its own finances. It was going broke because it had exposure to Wall Street. AIG had exposure to Wall Street. If Bear Stearns went under, that cost money at Goldman Sachs, at whoever their counterparty is. It's called counterparty risk. And so there is an inherent systemic risk in the options clearing corp and basically all the clearing houses that extends far beyond just Robinhood going broke because they don't have the money to pay. Somebody's got to come up with that. And generally, it's the entire industry has to come up with it. Tom Petterfee, he didn't say it outright, but Tom Petterfee is the chairman of Interactive Brokers. Today, at the end of the day, they were yelling at him, and he was yelling back, look, I don't want to be sitting here and paying for Robinhood's inability to cover its customers' losses. And so we decided to take a step to make sure that the system was working. And that was his response. They have tons of capital, Interactive Brokers. Robinhood does not.
And this is a critical point, because this is, depending on your perspective, depending where you are, depending if you're involved financially, depending if you're playing the options, depending if you're doing it short, depending if you're buying the stock, a narrative is arising that this is good versus bad. You know, David versus Goliath, the government and the again the swamp. Fill in the narrative that, you know, the big versus little. You know, the little guys are getting together and screwing with the marketplace. It's okay to do it if you're a big trader, but all of a sudden, you know, it's when the little guys get together and act in this manner that they're being shut off unfairly. What do you say?
So
what are your thoughts?
Being shut off is one issue. None of us should be shut off from trying to act in the free marketplace. I get that angst, but characterizing yourself as being for the little guy and characterizing all those people as being solely interested in the marketplace and doing the right thing, it was pure and is pure greed, pure avarice on the part of an intentional effort of a coalition of like-minded or even manipulative individual investors, along with hedge funds. There are hedge funds on both sides of these trades. Mm-hmm. So don't think that there aren't hedge funds in there rooting on and exacerbating the situation from the long side. And I just totally don't buy that buying GameStop, which is worth no more than $15 a share, in my mind, as a securities analyst, which I was, is worth 300, 500, 250, whatever it last traded at. That is pure mania. It is pure greed.
Tulips.
And yeah, it's tulips. Well, it does need to be said that Isaac Newton went broke in the South Sea bubble after 3 years of commenting on how it was going to happen and how you shouldn't get involved. He finally decided that he could time it, and he knew when it was right to get in and get out, and that's how he went broke.
If you're a fan of a certain period drama from PBS, as I think they called it Downton Abbey, in one of the earlier shows, he talks about how his investments with some guy named Ponzi, if you will, had gone astray. The market psychology is strong. It's alluring. Every one of us is looking at this and seeing the paper gains people are making. And if you're a capitalist at heart, which I think most of us still are, despite the best efforts of some political organizations, you want to be that guy or gal who makes that easy money. You had a couple people who that I met that made some quick money and were smart enough to just take their profits and run. I talked to one person online who paid off a significant part of their student debt. Holy cow. That's the real American dream, isn't it? To make money on paper by really, quote unquote, clicking your way through, So what, let's talk, there's two type of investors, three or so at stake here. You've got people playing the options, and if you've got folks who are buying the stock. So can you give us a perspective? And by the way, if you're just joining us, Michael G. Riley is an investor of not only of just high acumen, of an incredible experience, a lifetime lived in the markets. As I always like to joke, the markets are in his DNA. It's not even in your blood. We're well past that. Who explains it all to us, or if you're of a certain age, you remember the great line, Lucy, splain, Lucy. Well, Michael, splain, Michael. So, because what happens is in that, you've got folks in this online community who are, despite the fact that they're individuals and would portray themselves as, the little guys, are pretty experienced day traders, pretty experienced traders at large, knowledgeable. Now you've got this second and third wave of folks who are just seeing profits and not in simply buying the stock, not understanding whether it's a stock, whether it's the options. They're just sort of following the herd mentality, if you will. So what are the mechanics of this? How is this all working or not working, depending on your perspective?
Well, it's not even that, in my opinion. There's a multitude of opinions and behavior. If you've ever been on a casino floor, this is very much like casino type activity. You hear a lot of yelling and screaming at a particular table, and you go to that table to play craps, and then eventually, of course, the table goes quiet and everybody leaves. That's what's going to happen here. I mean, there's no question in my mind. But if you are smart enough, as you suggested earlier, to play the game, get lucky, even though you may not think you were lucky, you probably thought you were smart, and walk away, that's the right thing to do. The options angle on this is most people don't have enough money to buy a $50 stock, much less a $500 stock. So they have to buy option contracts. And option contracts, by and large, trade at, obviously a fraction of the price of the underlying shares. But somewhere around a year ago, there started to be this behavior where there was out of the money call buying, and in large volumes, and it seemed almost planned, and the stocks would react in a very unusual way on expiration week. These options would have 7 days left, and somebody be buying these options that prior to this year would never have even traded before. But not only were they buying them, they were paying any price to buy them. And suddenly this would turn into the right thing to do by Thursday or Friday, and then it would all unwind. And this has been going on for like a year now. This is part of what I think is this whole greed, manipulative behavior. I don't know where it comes from. I have no idea. I never knew who the beeper guys were in in the dot-com bubble. I was the guy on the other side of the trade. It looked too high to me, so I sold it, and I tried to buy other things against it. I don't really care why you're buying or selling anything. And in fact, we used to joke in the 87 crash when we had portfolio insurance, and the portfolio insurance was blamed for the crash on that Monday morning, down 20% or whatever the market was. It was down 22% for the day. But on that Monday morning, there was all of this haranguing going on, and it wasn't CNBC back then, it was FNN, on FNN, Financial News Channel or something like that, that saying that it was portfolio insurance that was the problem. And people should have to say why they're selling something, because they're selling it at a price that's way below its value. And they wanted to start to put reasons on the back of the trading ticket as to why you were selling something. And it's the same kind of paranoia that's going on right now, but it was a much less developed market. And now the paranoia is about whether something is worth something or not, or whether somebody's screwing them or not. It's all part of maniacal markets.
So if you're,
I think I forgot the question you just asked. So were you looking for an answer and didn't get it? Because
in a real sense, I'm just trying to understand, where on one hand, and this is the conventional wisdom as of today, on one hand, you've got, and you pointed out on one already, the duality behind this, but on one hand, you've got, these folks, these hedge funds, and these hedge funds took extreme shorts, if you will, on the on a handful of these stocks. The stocks du jour are obviously AMC and GameStop. A few short months ago, it was Blackberry. So you've got the hedge funds going short, and you've got all of a sudden this. And please tell me where I'm wrong on this, because I'm not an expert at all. I just simply play one on the radio. You've got these organizations now that have loosely coalesced under the guidance of Reddit and or other forms of electronic communications that are, at least at surface value, are trying to pump the stocks. And it strikes me as a classic pump and dump operation, by the way. You have to be sort of the 80s or 90s cats to get to that term. But, it's almost sort of they're pumping it up to, make profits and screw, if you will, as a byproduct of this, quote unquote, the hedge funds. Now, you've already pointed out the big lie number one, which is you've got hedge funds operating in a marketplace like they will, which is they've got their own agendas, they've got their own formulas, their own outlook, and their own, if you will, strategies. So what's happening with, if you will, folks who have options versus folks who are buying the stocks? What's the behavior of both of them, and what are they trying to achieve?
So the hedge funds community is on both sides of this trade all the time. Mm-hmm. The jealous and hedge funds that are underperforming the other hedge funds try to, if they catch them being short, they squeeze them. Or in December of 2018, when the market suddenly collapsed out of nowhere, they squeeze the longs. I don't know if you never heard that term before, but they basically sell stocks that they know that funds own, and they're facing a redemption period. And if you know a fund is going into redemption in 30 days, you basically look at their positions and take the other side of every one of their positions, because they got to get out of them. So the only question that you have as the hedge fund is whether you're going to be bigger than the actual liquidations that's going to take place. And so in this case, the hedge funds are sizing what they think the other side is going to have to do. This is a very unusual case, and why it's created a lot of interest. The net short position is greater than the float of the stock in GameStop. That isn't the case in Bed Bath & Beyond. That isn't the case in AMC. That isn't the case in even American Airlines, which was this morning. That isn't the case in any of those stocks, but it is the case in GameStop. And theoretically, if there are more short shares outstanding, first of all, you have to explain how that could possibly exist. But where is the short going to be able to buy back his shares from? And there is an answer. The answer is the company could issue more shares. And in this case, I think the company is being negligent by not issuing shares into this panic, because if you're GameStop and an actual entity that wants to further gain, you haven't gained because the stock went up unless you sell shares. And you sell shares by going into the market and taking advantage of this raise. They should be raising equity into this.
Right, because ultimately, this is the great irony, if you will. All of these companies that you've mentioned are just sort of bystanders watching this madness go on. And yet, if there's a common denominator between a lot of these companies that we've talked about, Kodak, all of them, is that they're all on the verge of a fiscal nervous breakdown, and they all need cash. So that's my question. Why aren't they, like you said, just rolling out the stock, and listen, you want to buy stock? I'll sell you stock. Because ultimately, go ahead, buddy.
That has happened, and that's what some companies have done. The classic example is the airlines. The airlines, because of the pandemic, had all kinds of losses, and you could make a case for they'd be broke if nobody bailed them out. And so American Airlines, for example, had to sell stock into one of these rallies. And today, let's put it this way. I put out a tweet for the hell of it at 10 o'clock, and I said, I'm looking at GameStop. It's trading at 480, up 200 or some odd thing. And I'm looking at American Airlines that's trading at 18. And American Airlines has a large short interest, as you might expect, because they had a pretty difficult time making any money. Mm-hmm. And they've got a long horizon ahead of them. But they actually have much more of a reasonable outlook for 20 years of existence than does GameStop. And why is GameStop trading at 500 and American Airlines 18? Why couldn't American Airlines, now obviously 144 characters, I didn't say it all this way, but why couldn't GameStop be American Airlines be 500 tomorrow? And I swear to God, within I would say within a minute, the stock went from 18 to 25. And that's a huge stock.
Yeah, what's crazy about that is that very often day traders or professional traders like yourself, you're playing a quarter point, a half a point. That's considered particularly on a lower valued stock. That's considered a move. And now there's an entire class of investors out there who think it's, I don't know if I want to say it's normal, but it's a reasonable course of behavior for a stock to double or triple in the space of a trading session. And that's not the real world, is it?
No. Although maybe it will be the real world. You never say never, but right. Historically, this type of behavior is at the peak of something. It's at the peak of a market. It's at the peak of sentiment. Oil wasn't supposed to trade at negative $40. It did last March. Mm-hmm. We have $13 trillion in negative interest rates outstanding globally. I took a lot of economics, UConn, Stanford, so on. Nobody talked about negative interest rates. It wasn't even a discussion. But now we all accept it. Yeah, that's the way it goes. So, and the implications for low interest rates and negative interest rates, even from somebody as smart as Howard Marks of Oaktree, is that if you're discounting future cash flows, which is how you value stocks and how we should be valuing GameStop as a company, when you discount those future cash flows at a very low interest rate, well, the value becomes much higher. That future value becomes higher. And if it's zero or negative, you start to mess with the notion of infinity. And Howard Marks even said this. It's possible that stocks could be worth infinity. Now, I'm pretty sure that it's not. But, I used to joke that I've never seen anybody come into my crowd and say, I'll bid infinity for whatever. It just doesn't happen. And so there is a lot of confusion out there about the value of everything, and whether it's an option. And I have stories about the options and the 1987 crash, when market maker friends of mine were almost literally arrested. They were accosted by regulators, taken before a kind of a tribunal, but a board of regulators and academicians who explained to these market makers why options could not trade at greater than 100% implied volatility, which they did that day in an option called XMI, which was the equivalent of the Dow Jones Industrial Average. They disgorged these market makers of money. They took the money and they put it in a fund and paid off investors who were complaining about option prices that day. That's what happened in 1987. The last 5 days, the average volatility in GameStop options, yes.
I can't even imagine.
Implied volatility, 1,000.
Wow.
So how come the regulators aren't out there telling the market makers like Citadel that they can't do that? Why isn't Citadel disgorging to all losing customers? It's not happening because the academicians were wrong. The regulators were wrong, and they're wrong now. So we're not going to get any satisfaction about all this. And now you have the politicians jumping on this. You had what's her face, Elizabeth Warren today out there, AOC out there. They're all trying to jump on the populist side of this argument. Only they can't figure out how to do it.
Well, what started our conversation this morning, and I won't mention names, was a local media outlet, we'll just leave it at that had written this, innocuous 3 or 4 paragraph clickbait piece on the price of oil and as a result gasoline. And that individual used the term optimism to describe what is clearly a multi-pronged, sophisticated, complex, multi-dimensional pricing model, which is at the root of which is everything from our fiscal policy to the Fed to exogenous events. I mean, the cross currents, if you will, of events that dictate the price of gasoline are astonishing. And to simply take a swipe at it and say it's optimism, holy cow! This is a responsible news organization that's putting this crap out. My terms, not yours. Utter garbage, fiction, oversimplification, the Disneyization of fiscal policy. I could keep going, but it points to a root issue in what I'll call the non-sophisticated, non-CNBC, because clearly there's people at CNBC, as you put it, the successors, if you will, to FNN, who are clearly sophisticated market makers with a great deal of experience, economists, people with experience, people who know, people who understand. And then there's, a couple of rock stars out there, but in the conventional media, the deep is the stupid. And these folks can't even explain fundamental pricing models like gasoline, because it's straightforward in a sense. How can we expect them to understand this? And as a result, the same sort of facile, superficial treatment, if you will, that fits individual political agendas, of course, is going to come to play on this, because I have, seen an opportunity. We can't let a good crisis go to waste, right? Isn't that the mantra of government now?
Well, I can tell you from my years, I used to be on FNN and Yahoo Network, and a couple of the people that are now on CNBC either were financed by me on Wall Street or worked for me. And I know them well, and they're on TV every day. And I know for a fact that all of us, none of us, know the answer to why something is up or down. I mean, just at a very basic level. And so when we surmise, as I am surmising today, I don't know why anything's up or down. As I am surmising today, it's based on a feel, on experience, and it is, generally valuable to hear it. But the notion that we know, or someone knows is ridiculous. And so, like Warren Buffett says, he doesn't know. Nobody knows. But he tries to make good bets and good assumptions, and he looks at risk versus reward. I don't think that's happening in Robinhood. I don't think that's happening at all.
We've only got a few minutes left, and again, if you just joined us, Michael Riley is someone who has been a prominent, if you will, participant in Rhode Island politics, Rhode Island economics, the greater Rhode Island conversation, and again, who's got a lifetime of expertise in markets and in trading, and understands really the truth as opposed to urban legends. A lot of urban legends floating around today, boy. Has joined us. What happens to Robinhood now? I mean, where do we go from here?
Robinhood's going to have some regulatory issues, no matter what, and they're going to be looked at. But right now, everybody's kind of on their side, saying, well, that's not true. They are mad at Robinhood for not allowing them to trade today. But the other issues of Robinhood may come under regulatory scrutiny, such as knowing your customer rule, educating the customer about exactly what they're doing, various very basic things that are supposed to be done. You're going to find that they didn't do them. Much like you found that Wells Fargo was not following the rules back in the housing bubble. So that's going to happen. But Robinhood won't be the only one. But anybody that's involved in all these short squeezes, you're going to find that there were people jumping on board that have no freaking idea what they're doing. I mean, none.
I had a couple call me today and saw this, and I'll go back in a completely unrelated event. I'll go back to what happened at one of the Donald Trump campaign stops, and when the TikTok generation got together, and I know a couple of people personally did it who subscribed to the event simply to not show up intentionally. And if you appreciate great practical jokes, regardless, we'll stay away from politics tonight, but just simply as a way to just torture somebody. Wow, holy shnikes! For an event then that described as oversold became one of kind of, I believe, a real delineation of market forces, if you will, in the political world. You had the youngins all of a sudden taking advantage of this disruptive technology and literally sending an incredible message to one of the two sides, if you will, in the presidential election. That is alive and well, and I think it would be foolish for any of us to be so naive as to think that this is the last time that this is going to do this. We have seen the future, I think. Absolutely. It's going to happen. And the success, or let's just say the drama associated with all of this, is compelling for a large number of people out there who feel completely disenfranchised by the world, the economy, politics, you name it. And, you're talking about a generation that has now twice in their lifetime felt, if you will, the impact of recessions and collapses and exogenous events, and a lot of them feel pretty picked on, and they're willing to take some broad swipes across at large groups of people. And it's not lost on me. It's not lost on me what you're saying. I mean, I really do hear what you're saying, but it's not lost on me that the behavior of the Capitol riots and all of the back and forth and hatred between both sides and the angst, visible angst, and all of that is playing itself out right now in GameStop longs and shorts. It's the same general, I'm right, you're wrong, F you, you don't know what you're talking about, I know everything. It's really very, very similar behavior. There you go. Well, we need to do this more often, quite frankly, because I have a great time. I really enjoy our conversations. There's a there's a worldview that you and I share. There's an expertise that you've got that just needs to. I cherish the times that we spend together on the air, because it's just, as one of my kids would say, it's a hell of a good time, even as the world is literally imploding around us. Yet the information, the accessibility with which you deliver it is compelling. So I'm glad we reconnected over some of the worst possible reasons, but hell, it's great to have you on the air again. And I think we need to do this every few weeks when you've got time or as events dictate, and just let's bring clarity at some level, as technical as these conversations can get at time. Let's bring clarity to a marketplace where there are so many agendas that it's sometimes difficult to kind of wade through the nonsense and the white noise and really get to it. So we always at the Coalition end shows with what we call shameless self-promotion. If you've got something to pitch, whether it be your services, ideas, just let us know so that we can engage, as we love to say, in shameless self-promotion.
I don't have anything to pitch, although I think Kurt Schilling should be in the Hall of Fame. What I know is not interesting unless we're in the middle of chaos. And so I hope that you won't really have to have me on again and talk about this stuff. On the side of Rhode Island, I want to do what's best for Rhode Island. And I appreciate your outlook for Rhode Island, and all the topics you've discovered, like boy did we dodge a bullet with Pawtucket. That could have been a disaster. Pawtucket would be broke by now. And, so I appreciate what you do, and I like to contribute to your thought process.
Well, again, you honor us by being here. I love having you on. We'll figure out a way to make this fun. I have a feeling that your voice is going to continue to be heard, particularly as, let's just say, Rhode Island's on a path. It's not a good one, and it's a conversation that you and I need to have again shortly. We've got a new administration here in Rhode Island. For folks who are local, there's hope there. I think that the gentleman assuming the governorship of the state of Rhode Island certainly, for a moderate Democrat, I think there's.
I like Jeremy.
Yeah, he's
how right I am. I like him.
Yeah, no,
I don't know what it is, but I like him.
Well, he's a good man. He's a decent man, and his attention to the needs of the small business community should not, regardless of the mess. And you talk about a guy inheriting a bleep storm. Holy shnikes. His contributions already should not go unnoticed, and the intent behind them. Let's just say, when it comes to COVID, he was cool, he was small business cool before it was cool. And you have to give him credit for that. In a time when, what is it? Where have you gone, Joe DiMaggio? A nation cry, Rhode Island cries, it's lonely eyes for you. And we are, if you're listening from out of state, we know you. We had a gentleman here from Kentucky the other night, similar situation, and they're going through the same crap. So we'll keep connecting, and thank you so much for joining.
I'll tell you this: if they take me out on a stretcher tomorrow because I've been run over by the GameStop crowd again and I'm short, I may need a job, and I may contact Dan McKee, because I could help Rhode Island in that spot.
I like that. I like that. Let's put that out there. Dan, you listening? There's folks who are ready. There are folks who are ready to help.
I mean it.
Absolutely. Folks, you've been listening to The Coalition. We are The Coalition, loud and proud, outrage porn free, civilly disobedient media, broadcasting live on the worldwide Coalition Radio Network at coalitionradionetwork.com, facebook.com/The Coalition Radio, on the mighty Twitter at Coalition_radio. Folks, stay tuned. In just a few minutes, we're going to try and get Scott Horton on the air. A completely different issue. We're going to talk about the anti-war movement. We're talking about peace. We're going to talk about Yemen. We'll be right back. Thank you.
Great.